everyone, and welcome back to Lindy's monthly financial and property update. This month we are, of course, in March. As I mentioned last month, it's actually now been a full year since the RBA first dropped the cash rate in 2020. And for those of you who may have locked in their interest rates for a fixed period of this last year, you might be coming to the end of that and wanting to know a little bit more about what your options might be. So that's the focus of today's video. We'll be discussing what you should be considering next, unpacking the reasons behind why we're seeing such incredibly low fixed rates, in fact lower than variables in the market today, and what impact that had on the economic crisis. So welcoming back today is our co-founder and CEO, Dave Hyman. Welcome back, Dave.
Thanks, Zara. Great to be here again.
So we'll dive right in. As I mentioned, last March we saw 2 emergency rate cuts by the RBA to keep consumer confidence afloat and stimulate demand in what was potentially going to be a relatively uncertain economy as the COVID pandemic really started to take hold. Many of our listeners will have fixed in that period with a record low interest rate at the time, but be nearing the end of that expiry date. Dave, could you give us an insight into the market today? And whether those customers should be considering to keep a fixed rate or potentially go back to what was a more standard rate, which is a variable rate in the climate we're in.
Yeah, I think that's a great place to start. So I think, as you mentioned, 12 months ago, there was a lot of uncertainty. March 2020 was the start of, the global wave of lockdowns as the pandemic was taking hold, and there was a lot of uncertainty, and a lot of people took the steps, as you mentioned, to fix their interest rates as the banks came out with really, really compelling fixed rates as part of the stimulus package, and we'll touch on some of those points later in the segment. But I think, and I'm sure I speak for all the viewers when I say this, that the level of uncertainty that was in place 12 months ago is vastly different to now. If you sort of go back and think through what's happened in that very short period, we sort of had the uncertainty of the pandemic itself, and in that short period we've developed a vaccine, and it's now in the rapid stages of rollout around the world. So I think the level of uncertainty, while still exists, it's much, much lower than where it was. And so I think when we then look forward and think about what's the right thing to do for consumers in this market, when we look at fixed rates in market and those fixed rates being relatively lower than variable, so we're seeing sort of 1, 2, 3 and 4 year fixed rates certainly below 2%, some as low as 1.79, 1.89%, vis-a-vis the variable rates, which, like for like with the same banks are more in sort of the 2 to 2.5% range. And given where we are in the interest rate cycle, so the cash rate, the underlying cash rate is 0.1%. And we've talked in past segments around the likelihood of that going below zero, and the house view is that it probably doesn't. Based on all of those things, if you've sort of understood things like break fees and understood things like offset accounts, because there is such a big difference between fixed rates and variable, we think that for a lot of people at the moment is the right time to fix.
You touched on fixed rates being lower than variable rates with a good many lenders out there today. And some really compelling fixed rate options as well out there. Could you maybe explain to us why that's the case, and also the kind of resulting impacts to the market of that?
Yeah, absolutely. So I mentioned that the government stimulus was one of the drivers around the current fixed rate offers in market, and I guess unpacking that a little bit further, one of the first things that was launched to market as part of that stimulus package in March last year was a thing called the Term Funding Facility, or the TFF. And what that is it's effectively a wholesale facility put in place by the Reserve Bank, sponsored by Treasury, whereby the banks in this market are able to access very, very cheap funding for 3 years. So there's a fixed rate of 0.25% for the banks, and so you can quickly see the margins that banks are making here. But ultimately, they've been able to turn that into very, very cheap 1, 2, 3 and 4 year fixed rates for the customers. And the difference there between sort of the fixed and variable rates is obviously the variable rate still exists, but how the banks ultimately source the money for those loans. And again, it differs bank to bank. Some have lots of deposits, some will go into the wholesale markets to source these funding, but there is a high level of cost to do so, and that ultimately results in difference in those rates. So because of that TFF being in place, as I described before, we're in a situation where fixed rates are lower than the variable rate, and that's obviously a really favourable place for borrowers to be.
Before we let you go, what would you say to those who are coming to the end of their fixed term or potentially haven't actually looked at refinancing and are still sitting on a variable rate that might be older than 12 months ago?
So I think on the refinancing point, because I think they are separate topics. Firstly, given all that we've talked about today, in particular where fixed and variable rates are, if you haven't refinanced in the last 12 months, stop everything that you're doing and start that process. You should work with an expert to understand what your options are, but the background to all of that is the amount that interest rates dropped over the last 12 months versus some of those older products from sort of 2, 3, and 4 years ago means that there's a material saving that you can make, sometimes as much as one whole percentage point. So it's imperative that you take those steps and look at whether refinancing makes sense for you. For the second part of your question around people who fixed a year ago and are looking at what do they do now, well, I think I sort of mentioned before some points around things like offset accounts and things like break fees, etc. Go through the process with a home loan specialist or an expert and understand exactly what those mean in your situation. But really, to sort of oversimplify, if you're not looking at moving away from your house for the next couple of years, and your mortgage is not just $20 or $30 or $40,000, you've got a sizable mortgage, fixing in this market is a very, very smart thing to do. But obviously go through that process, get some advice and understand how it might impact your situation.
As always, really sound advice. Thank you, Dave. For anyone out there who is coming to the end of a fixed term on their mortgage, then please do get in contact, lendy.com.au, and one of our home loan specialists will be really pleased to help you. As always, our advice is free and our service is free, so do feel free to jump on the platform. Thanks again, Dave, for joining us, and we hope to see you next month for the next Lendy Property and Finance Update.
Yeah, thanks, Zara. Thanks for having me. It's been great to be here and look forward to being back next time.